Welcome to the Property Trio podcast, the podcast for the sophisticated property buyer. And today it's market update, and I'm joined by my esteemed co-host, Dave Johnston. G'day, Dave.
G'day, Mike. Just you and me today for the first time ever.
We're missing the fairer sex, so I don't know how the reviews will go, but Cate is she's predisposed for this one, so it's just going to be you and I talking through the numbers. And what an interesting data set we've got when we look at the February core logic data. And the first thing that sort of stood out to me, I'm keen to hear your thoughts, is a changing of the guard. Darwin won 2025, but on an annualised basis, we've got Perth back. That market just won't quit.
Perth just won't quit, will it? It's the city that keeps on giving. So Darwin seems to have hit its glass ceiling, and it's just fallen dead in its tracks according to Totality anyway, with just a 0.2% rise in February. And Perth, another 2.3%. So that is 24% plus annualised capital growth, which is quite amazing after such a sustained run. But, you know, we have talked about, you've talked about it, I've talked about the fact that, broadly speaking, though, because Perth had been so flat for a decade, a lot of its metrics actually aren't that unreasonable in terms of, you know, income to price ratios and that kind of thing, are they? So, you know, you can understand after a decade of next to no growth at all why it might run a little longer than some of the other capital cities.
Yes, and we chatted about it at our live podcast recording, which, as at the time of recording this one, was last week. So shout out to everyone that got along. We had some awesome questions, and that will actually end up an episode that we share, which I think is still going to be very current and relevant. It's interesting when you sort of say, like, you know, Darwin seems to be dead, but we're still talking an annual growth rate of 19.4. It just begs the question, because it's a small capital city, is it just segmentation issues? Have there not been terribly a huge amount of transactions in February, and what does the future hold? But you raise a good point with Perth. The affordability metrics are still kind of there, even when our median price in Perth is looking at around 989,000. People are on fairly high salaries, and the median in Darwin is 602. Like, it does feel like it has potential more room to move when you look at household incomes, but they're not as strong as Perth, I would assume. I don't have that data. What's your feel?
Well, yeah, I mean, look, Darwin's sort of like a big regional centre, isn't it? With the population, I'm pretty sure is around 150,000. So, you know, it's significantly smaller than a Perth or any of the big five capital cities. So you imagine that, at least for the locals and whether they're homeowners or renters, price growth has to cap out a bit earlier because of just, you know, there's just not that diversity of population, of professions across the economy, jobs, etc. So economic growth. But Darwin has, you know, that graph which shows where all the capital cities have moved as being on the ladder of where they're most valuable, median, second, third, fourth, fifth, sixth over the last 40 years. Darwin has risen to as high as, I reckon, second, maybe third most expensive capital city at one little period there over the last 30, 40 years. So it has shown the capacity to keep up with the big boys, shall we say, and be up around their level from a median perspective. So, but generally once you get a change in trajectory like that, it tends to hold. It tends to become a pattern. You don't too often have a, 1%, 1%, 1% for a long period of time, 1% to 2% Darwin's been, and then drop down to a 0.2 and then jump back up again.
Yeah, it's unusual, but remains to be seen what will happen in the next couple of months. But of course, we'll be tracking it. For the month of February, some other highlights: Sydney and Melbourne, dead flat. We've got Brisbane again pumping hard, 1.6%, which takes it to an annualised 17.3. Adelaide, I think we're sort of seeing some cracks in that, but it posted 1.3 as well. And Hobart, which I think you and I call the bottom of, 1.2% for the month. That's 7.7% annually, which is surprising. So it's snuck in a couple of little bumps in the last little while, but it looks like it's time for that market to start humming along. What do you reckon?
Well, let's hope we were right, Mike.
Yeah,
our predictions
most important.
4 or 5 months
We
ago.
care less about the market and more about whether we're correct or not.
That's right. So, that's a bump, 1.2%. You're now looking at 10 to 15% annualised growth if that rate continues. And we saw a number of signs which made us call the bottom, and we'd been watching that for a few months in that Hobart before we went, when the trend becomes your friend, and then you're able to make a call, and that's starting to bump. And so, like, a couple canaries in the coal mine for is like rental growth. So if we have a look at rental growth, Perth's annual rate of rental growth has eased by 24 points relative to a year ago. Rental growth across Adelaide has eased by 2.8 percentage points over the last 12 months. A couple of those, Adelaide and Perth, obviously cities that have outperformed for the last 2 to 3 years, are starting to flatten out in rent, and that can be one of those price signals that shows the steam starting to come out of a market.
And are you looking at the yields or actually the rental growth just in isolation?
I am looking at the rental growth.
Yeah.
So because according to Catality's rental value, it's their index.
Yeah. Because we've observed this trend that we get this boom investor market, or a market that's booming, and of course investors are part of it, and then we actually see rents increase, and we're kind of like, doesn't make sense from a supply point of view. But we know that if there's a transaction where an investor comes in, there's a chance the longer the property's been on the rental market, the more it may have drifted from market rent, and a new purchaser will try and rectify that. So we see a short-term kind of increase, and then I suppose we predicted a longer-term detraction because of the huge amount of supply. I think Perth was maybe a good example of a fairly investor-driven market. I think Darwin even more so. So it then kind of begs the question, okay, well, have we seen a tightening in the Melbourne market? However, just crunching the data for 2025, Victoria has increased its percentage of investors in our data in that state compared to the rest of the country, sort of rocketing up into second place from pretty much the bottom of any of the major states. So what are you seeing for Victoria?
Yeah, look, there continues to be those types of signals for Victoria and Melbourne. And I feel like, your data, even though it's a subset and it's probably skewed a bit more to new than established, but it's proven pretty accurate with trend changes of where buyers are purchasing and where where investors are moving towards. So I look at, Catality has the hedonic index, which tries to remove it being about the median. And, if there's not as many properties selling in the, 4 million plus price range, then it shouldn't be as impacted as, say, a lot of the REI V1, which tracks a median, or some of the other ones that track medians rather than a hedonic index. But look, if you look at PropTrack's growth over February, which I've got here, it had all the cities sort of a bit closer together. So maybe there's a bit of that happening. Like, it had Melbourne actually having growth of 0.3%, whereas CoreLogic didn't. It had Sydney at 0.5. It only had Perth at 0.6, Adelaide and Brisbane at 0.7. But it did have Hobart at 1% leading the way. So even though they're technically potentially more skewed by what's selling at any given month, They also, I think, the median numbers in some of these other ones, indexes or whatever you want to call them, can provide some interesting insights that maybe sometimes Cotality will provide later on, almost because of its hedonic index is more sophisticated, so it doesn't pick up some things till later.
Yeah, interesting. That's quite a divergence between those two different methodologies. I'm leaning to prop track now because it says that Tassie is going through the roof, and that's just confirming our excellence as market predictors. Speaking of market predictors, we're
stop
at 9 points.
using Cotality from now on, as long as prop track's backing up our Hobart call from 5 months ago.
Absolutely. And if Kate's listening to this, she'll be like, gosh, I have 1 week off, and look at how this podcast's just gone to ruins.
She'll be shaking her head listening to this. Well, if she was with us now.
She would, yeah. Wait till she hears some of the cricketing metaphors that we're allowed to throw in while she's not listening. We'll get it back on track, though. National growth rate, 9.9% annually. I mean, that is all the hallmarks of a booming property market. However, in the news this week, a downgrade from SQM research on their forecast. I don't have that data in front of me, but anecdotally, we're talking about extra risks with the closing of the Strait of Hormuz. That's, I think, around about 25% of oil comes from Iran, a little bit more from the Arab states. 20% of the resource comes through the Strait of Hormuz, which is ostensibly shut at the moment. Trump had a call with a CBS journalist saying that he was about to sort of take over the strait, make sure everything went well. That was leaked to the media. The oil price dropped markedly, and then he, of course, was forced to go into a press release. It's an interesting
I just even heard, like, an hour or two ago, how he said if there are any bombs placed or mines placed in the Strait of Hormuz that blows up any kind of vessel, he will bomb Iran to a level never seen before.
Well, it's approaching a level never seen before already. But yeah, it's interesting and very, very sort of bizarre behaviour from Iran to bring in so many other states that now, according to international law experts, are able to launch sort of defensive retaliatory strikes. Right. So, an interesting case is America's got their own domestic oil production. They're not necessarily reliant on it, but the Asian states like China, India have quite a reliance on the oil coming out of that region. So I wonder at what point do they start entering the chat? I mean, Trump had a call with Putin the other day, and he sort of said he would like to be helpful. And I think Trump said, we'll leave Ukraine as a start, and then we'll talk about how else you can help. Hopefully that could end that conflict, because I think we must be approaching year 4 for the Ukrainian conflict, which is crazy to think about.
And China rely on Iran for a lot of their oil. Yeah, India, it's all interconnected, isn't it? He did say something yesterday, which appeased markets and sort of implied again that it may not last for a lot longer. So, which should stabilise a lot of things because, it's impacting interest rate expectations, isn't it?
Well, let's jump ahead to that one because we've just had the sentiment come through on that. We'll just go a little bit out of order and get Cate shaking her head again. Interest rate expectations for the month, negative 3.9. I've never quite understood what negative and positive means in this context, but presumably that is basically a much more of a baked-in expectation that we're not going to maybe just have one rise, but we could have multiple. How do you view that, right, Dave?
Yeah, so look, I've got some of the notes from the actual survey, and it said their daily responses point to a material weakening because over the course of the survey week, the results got worse. So they said likely reflecting growing concerns about the escalating conflict in the Middle East. So it increased. Well, consumer sentiment was 91.6 overall. So actually slightly went up from 90.5 in February, but over the last 3 days of the survey, the index read at just 84.
Well, I suppose it's a concern about inflation, right? And anyone that's gone to fill their car up with fuel, I actually haven't since the conflict started. I'm due. I'm putting it off. Anyone that's filling up their car seems to be also taking wheelie bins and drums, and there's been some really quite appalling behaviour witnessed. It's very reminiscent of the toilet paper stuff that we saw during COVID. But I'm not sure. I think the US will want to stabilise that trade and that area and that region fairly quickly. And Trump has even talked about removing Iranian sanctions, obviously once they're happy with whoever's in control, which actually could maybe do the opposite to the oil price. But gosh, there's too many unknowns right now, and I think we're up 25% oil prices in the last little while. So that's the fear, right?
Yeah, that's right. I think it stabilised a little bit overnight with some of his commentary around it potentially not lasting as long as others as expected. So, yeah, look, it's in a bit of a state of flux at the moment, isn't it? Yeah, he made some comments around, I think, the Ayatollah's second son has taken over, made the supreme leader by those in power who remain alive in Iran. And Trump made, I think, some comments about that not being ideal, but not probably as strong as he has been previously regarding hoping for regime change. And so, it feels like maybe his desire to keep this going for a lot longer or a longer period of time might be waning. Yeah. So that would provide some stability.
And I saw yesterday there was a picture of the actual wedge-tail surveillance aircraft leaving Williamtown Airport via Perth for Middle East. So Australia has committed at least a surveillance aircraft to assist in, I suppose, defence of our allies in the Gulf states, right? But we also have some service men and women on US submarines on consignment, one that sunk an Iranian frigate off the coast of Sri Lanka, I think it was. So I think Australia is very reluctant to enter into the war per se, but looking to help with the defence of our allies in that region. I wonder,
kind of thing. But then also we happen to have the Iranian women team playing the Matildas in the last, just coincidentally, and so then they didn't sing the Iranian women's team didn't sing the national anthem, and then a lot of there was condemnation from that some of the senior powerful leaders within Iran against that women's team. So now I was just hearing this morning, and the Australian government or representatives have been speaking to them and providing them with the opportunity to seek asylum, and a number of them have taken up that opportunity. So,
wow,
so there's Australia is now sort of, whether they like it or not, we like it or not, there's certainly some involvement in what's going on.
It'll be one to follow. So in that sentiment, what are we talking about in terms of economic conditions and ideas for the next 12 months? Time to buy dwelling index. What have you seen from the print?
Yeah, so with the print time to buy dwelling index, it decreased from 84 to 82.9. So people are more pessimistic that it's a good time to buy a dwelling. That is like the long run average for this was 120. So we're well and generally speaking, the average is people have been positive it's a good time to buy a dwelling. So that is that is not that is quite low historically. Now, what's interesting is the subsets within it. So they look at like, okay, what are people who have a mortgage? How do they feel? Well, they've dropped 16% down to 73. So people who hold a mortgage are not that keen to be buying a new dwelling.
Yeah,
Whereas,
well, I mean, it's your mortgage is going up, isn't it?
that's right, and only going to go up further. But there was interesting. There was a rise amongst renters of 10%. I mean, it's still below the overall average, but at 80, yeah. So because those who don't have a home but don't have a mortgage are unsurprisingly more positive about it being a good time to buy a dwelling. Their rating is 94. So,
Well, they love inflation. I can remember seeing a senior citizen interviewed in the newspaper saying, I hope inflation goes to 25% because I've just got all my cash in a term deposit and I'm loving it. I'm like, well, that's very great for you, old timer. But everyone else is suffering and there's a cost of living pressure, and maybe your comments are poorly timed for everyone on the poverty line. But yeah,
so
you can understand that, right?
Has their vested interest, don't they? Everyone,
Yes.
always back self-interest. But a couple more interesting ones across geographies. So home buyer sentiment fell more materially in Queensland, down by 5% to 76. And it's exceptionally weak in Western Australia, minus 15% down to 65. So, that certainly the locals are really pessimistic about it being a time to buy a dwelling. And these are the types of indicators we start looking for. And like red lights or green lights. I think with Hobart, it's like, there's probably 2 or 3 flashing lights for Western Australia here and there, or Perth. Once you probably get to 4 or 5 of those flashing lights, so you start to go, okay, there's a pattern occurring here that says this market is changing trajectory.
Headwinds. So when we look at back to the growth, Dave, and especially the regional markets, the February print was basically positive for everywhere. Interestingly, the worst performer was regional Victoria with 0.6, despite places like Ballarat anecdotally going through the roof. If we look at the past 3 months, we've got regional WA and South Australia in the lead. Tasmania, interestingly, in third place for the last 3 months. And if we look at on an annualised basis, it's been really good times for WA, South Australia and Queensland, as kind of outlined in the capital city growth for those areas as well, but a little bit more positive for regional Tasmania. The regions are doing better than the capitals at the moment. If you look at the last 12 months, 11.1% growth for the combined regions, as distinct from 9.6 in the capitals. What do you make of that? I mean, it feels to me like price point has got to be factoring into that conversation, with investors, rarely spending much more than 750K across the averages, from at least what I can see.
Yeah, I think, price point, which then work from home phenomenon, which also feeds into really high rates of internal migration. So more people moving from the cities to regions than ever before. And that's been a trend that started in COVID and has continued longer than I would have expected, to be honest. So, so regional markets is showing a trend outperforming the capitals across New South Wales, Victoria, South Australia and Tasmania, with demand more resilient thanks to lower price points and evidence of rising internal migration rates.
That's an interesting one. And when we broaden the scope and look at the change in dwelling values since May 2022, which is, post-COVID and the start of the hiking cycle, that tells a very interesting story, where we've got markets like Melbourne, which since May 2022 has posted 0.5% growth. But then we've got Perth at 68.7, Adelaide 40.2, Brisbane 3.2, and Hobart is still actually 3.2% down on May 2022. It's certainly not the case that all markets have been moving together in those last few years. What do we make of that as investors?
Look, I think what is the macro story there that's occurred since May 2022? I think it's affordability story, high level, and that's for owner occupiers and then investors as well. So all those capital cities, those smaller capital cities, particularly Brisbane, Adelaide, Perth, were more affordable. I think strong economies off the back of mining, and that story's just played out for a long period of time. I mean, Perth is far and away ahead of Adelaide and Brisbane since May 2022, and I think locking down their borders created a rubber band effect, which people wanted to get in there while the borders were closed, so there was this build up. There was lots of people who couldn't move into Perth for a year or longer. So that sort of compounded what's gone on in Perth, I think. And and Hobart had an extensive run leading into COVID.
True.
And prior to that period. So and I think it was a bit of an escape for a lot of people, and probably a lot of Melburnians in particular, over that period. So it's then found it tough since May 2022. So there are a couple of reasons why it struggled, but looks like it's back on the run again.
That was a really galloping market pre-COVID, and perhaps COVID even maybe sort of stunted that to some degree. And on the back end, it didn't rise like we saw other places, because I suppose it was maybe the strongest market in the lead up to COVID. Now, we've talked a little bit about rents. They're not growing at the pace that we've sort of seen in 2004, but still way higher than the long-term average. We've seen investor activity go pretty crazy. No vacancy rate data has been released for us to share with you guys for this month. But when we look at investor behaviour and the lending indicators that we saw, and we may have touched on this before, but a 23.6% change from the December quarter 24 to December quarter 25. That'll be an interesting one to watch as we head into the May budget, because we have sort of all but confirmed a change from the 50% CGT exemption down to 33, and potential reform coming to negative gearing as well. If those things are legislated, how do you expect investors to react?
Like with most things, people will overreact to begin with in the short term, and then it'll find its level. But I do think it'll have some sort of impact on price growth over the long term. Now, whatever that looks like, if on average your property prices have grown over multiple decades, let's call it 5%, and there's a bit less of an incentive to get into that investment class, it might shave 0.5% off long-term growth or something like that. I suspect, that's sort of how I would see it playing out. I think it's less likely they'd bring in anything around negative gearing. I think they'd be more likely to do one thing at a time. But yeah, what are your thoughts?
Well, I think people have said if there's ever a time to do it, it's now. I think it depends which angle you're coming from as to whether that is true. If the angle is we are going to have this sail through the lower and upper house because of Labor's dominant hold on power there, then the answer is yes. But if we're talking about the timing for anything that makes headwinds for property investors when we're talking, 1.3% thereabouts vacancy rate. I think anything that discourages investor participation is going to hit the rental market. And it would be great to think that all of these renters go into owning their first home and there's no change to the overall supply because investors leaving will be replaced by first home buyers. But we've never actually seen that work perfectly. For example, when we had the Melbourne exodus of property investors, there was still around a quarter to a third of them were selling to other investors, right? Not first home buyers. So it's just shifting the tables around the deck, I suppose, a little bit. But that's of most concern for me. Rents have been going absolutely through the roof. And I think there's a lot of commentators that are saying, well, this is really important reform. But the government needs to step in with their public housing contribution. I just don't like the idea that the government has sort of stepped away from owning rental accommodation or public housing and outsourced that to property investors, and property investors have taken that challenge with open arms. But now they're pointing the finger saying, investors are greedy and terrible and all this sort of stuff. I just don't think you can have your cake and eat it too as a government. And at the end of the day, they're failing on their supply targets as well. The 1.2 million homes, we're closer to 170, 190 a year than we are the 240,000 a year that we need. So I don't know, maybe I've got a vested interest in all of this, but I'm worried about the timing and I'm worried about the rental market. What do you think?
Yeah, rents are rising at a faster rate. They've started to speed up again, and that's been a story of about the last 4 or 5 months. Now, that's a worry not just for people looking to rent, but it's a worry for everyone because that's a key number when it comes to inflation. So that's putting pressure on inflation. If rents keep rising at this rate, we're more likely to have more rate rises, harder to get inflation under control, which means the cost of living relative to your earnings, it becomes more and more expensive. So there's a few flow-on effects there. I think vacancy rates are so low. Every market has got even lower, got even tighter according to SQM on vacancy rates, except for Hobart, which has stayed the equivalent. But it's already only 0.4% vacancy rates, which is one of the reasons, was one of the price signals around Hobart with vacancy rates lowest in the country. So it almost can't get any. You'll have no rent, no unincome vacant properties almost if it gets any lower than that. So look, we know the government needs to create more supply. I think one thing that we've seen in Canada is they've capped their migration levels, and they've seen their property prices flatten out. So I think there's a fair bit of political capital, jungle drums are beating, if you like, to continue to reduce into overseas migration into Australia. That obviously means you don't have to build as many new properties each year. So that's one way to also skin the cat, so to speak. It's not good for our economic growth necessarily or GDP growth, but if you boost up supply, you reduce overseas migration, and you make less benefits when you pay more tax when you sell an investment property. All these things will go towards slowing property price growth, I think.
Yeah, you raise a good point. I mean, immigration has been, I suppose it's come back from the peak. We're probably talking December quarter 2024, the peak of immigration thereabouts. But a lot of pundits sort of saying, look, we're in a per capita recession if we take that away. We've just had GDP data released last week. Australian economy rose 0.8% in seasonally adjusted volume measures. Nominal terms, GDP rose 1.8%. Household savings income was an interesting observation as well. What did you see there? And is that sort of an impact of global uncertainty or just interest rate bites, do you think?
Yeah, probably both. To be honest, with Australians saving more money, yeah, their conscious rates are going to go up. The instability around the world, cash is the safest haven in times of instability. So, yeah, that would be, I would suspect, why that's happened.
We've seen meaningful changes in agriculture, forestry, fishing, mining, wholesale trade, accommodation and food services, transport, postal, warehousing, financial insurance services. That's not a surprise. Insurance inflation has been absolutely crazy. And when we look at the government, the 3-year bond yields, and the AUD for that matter as well, with the implications of further rate rises, the Aussie's been doing fairly well.
Yeah, the Aussie has been doing well for anyone looking to travel overseas, or maybe have offshore staff, and that certainly helps with your conversion when you're paying their salaries, having the Aussie dollar appreciate. So, yeah, it depends on your drivers or your business. But certainly we've seen the bond yields increase. So, yeah, just looking here as of the 10th of March, the 3-year bond yield was up at 4.5%. So that is almost 75 basis points, almost 3.25% rate rises above where we're sitting at the moment, which is generally a general feel of where the markets expect rates to move to. And they're currently got a 90% in the implied yield, a 90% chance of a rate hike for the May meeting, and they're betting in a 100% chance that we will have had at least one rate rise by June. And it's actually, they've got a 100% chance at the moment that we'll have a second rate hike by October.
Yeah, wow. Yeah, so we can obviously see that in the data. When we're looking at inflation as well, the wage price index, the unemployment rate, these all feed into inflation. Unemployment has remained really, really low, and we're still seeing wage price growth. What are you seeing in the data there, Dave? And is there any respite that you can see in that data for inflation? It doesn't look like it from my perspective.
Yeah, not from those numbers. Obviously, we're getting the stories about some of the big software companies who are like Block. If we
Right.
look, I guess the canary in the coal mine with unemployment is AI, artificial intelligence deployment. And what we're seeing first across Block, who bought out, most Australians would know, Afterpay. Their founder, Jack Dorsey, was the founder of Twitter. He owns a number of sort of payment type big software companies. They have retrenched a large percentage of their workforce. So is
40%. 40% apparently for Block. I'm just pulling up the data now. So WiseTech, they scaled back 2,000 jobs globally, which is 29% of the workforce. That was announced this month. CBA announced 300 job cuts while investing roughly 90 million in AI systems and workforce transformation. ANZ, NAB, Bendigo Bank, they've all announced some cuts. Block, as I said, 40% of its workforce. So we haven't really had much discussion yet in Australia up to this point. This is probably the first time we've seen major tranches of job losses. This threat of AI taking over has been around for quite some time. Interestingly, that this coincides with the Opus 4.6, I think it is, for Claude, and the OpenAI Codex. The acceleration of AI tech has now got to the point where it does seem like it'll make meaningful changes in the job market. And to me, it was explained to me in a way that now makes perfect sense. Like, people were saying, oh, well, AI is coming after jobs, and it seems like, oh, it's going after coder jobs. But it's not really going after jobs. It's just investing as much time as possible in the skills it needs to build itself, right? Because AI is code. essentially. And it's got to the point where I have a few coders in my network that basically saying, look, I see myself as being redundant. I can't really do anything better than what this is doing. And the OpenAI companies themselves are saying, well, the latest release is the first release that was meaningfully created by itself, in terms of we actually outsource quite a lot to the AI itself to further itself. And I mean, those are terrifying thoughts when we talk about the singularity and Skynet and all the stuff that people have sort of forewarned us about. But it'll be really interesting to see what happens with that.
It really feels like, I feel like that we're right at the start of the tipping point. So that's my feeling over the last month. AI speed and its transition into businesses and starting to impact, like software engineers, ironically, the people who probably spend a fair bit of time building the artificial intelligence with coding to begin with. It's now being able to do their jobs and other white collar type jobs. And there was a really interesting article by the founder of Testbox, which allows software as a service businesses to go in there and test their business with potential users to see how effective it is. And he just wrote how he just, AI, and it was a lot of wasted time and, up until this point, but now using Claude in particular, he's saved something like $250,000 across a year by some of his software engineers working with Claude have then replaced a lot of the software tools they previously paid for. And that was a real eye-opener for me as to how you can implement it within your business. And, he's saying how, they can build their own Confluence now. They've sort of built their own e-marketing system, and it can be more tailored. It's not perfect, but within a couple of weeks, they were able to go, okay, we're not going to pay for this software service anymore. We're not going to pay for this software service anymore, because they've been able to build their own with Claude in particular. And so that is that really makes sense to me of how it will start to cost jobs. If you can basically build, some software that otherwise used to be really difficult to build and you were having to pay someone else to provide it to you. Yeah.
Yeah. People are saying software as a service is dying. We've seen Atlassian shares falling, and Mike Cannon-Brookes jumping onto Loom, their own platform, to talk about why he thinks like it's overblown. But yeah, those are meaningful job loss announcements. So that'll be a really interesting one to chase, because if we do see more and more of that and the unemployment rate rising over 5%, that's going to put take a lot of pressure off inflation and interest rates. But we're still seeing growth in the wage price index today, right?
Yeah. So there was the back page of the Financial Review today. What was a thesis from one of the senior Macquarie analysts, and just saying, look, this is what's Australia going to look like? How will our banking system hold up? How will our social system hold up if we go to 10% unemployment? Because if you can see AI taking these types of jobs, and it's not necessarily half the jobs in the workforce, but if we go from we've been so used to 4, 5, 6% unemployment, and the RBA will been really conscious to protect jobs for a long period of time, and so is the government, but we no longer sort of have a working memory of what life is like with a 10% unemployment. And he was just questioning what challenges Australia might face if that was to happen, with probably the structures we have in place at the moment, because it's been such a long time since we had that level of unemployment.
Yeah, so it's a reasonable thought experiment. And yeah, it'll be an interesting one to watch. But we'll keep you up to date as much as that impacts the property markets on the Property Trio with our monthly market updates. Now, Dave, before we wrap up today, is there anything else you want to share and close?
Probably not. No, but obviously we're talking a bit of gloom and doom there with the potential for AI, which will certainly put some people off property investment. But, history suggests the Australian property market outperforms inflation over a long, long period of time. And one of the key reasons is because everyone needs a roof over their head.
That's true. It's a tangible thing that survived multiple world wars, so you'd be brave to bet against it over the long term, I think. So hopefully that's a slightly more positive one. We can just nudge that one down to third man and at least make a couple of runs there. I've thrown in the cricketing metaphor. I'm not sorry, Cate, but I am sorry that you couldn't make this one. But Cate will be back for the next episode, but it's a big thanks to Dave for sharing that market update with us today, and we look forward to bringing you
Mike,
more.
For driving the agenda so beautifully and adding your pearls of wisdom throughout. We missed Cate, but I think we managed to get through okay.
I think so. I think hopefully we won't get any 1-star reviews for this one, Dave. I think we've done well. Thanks, mate,
Fingers
and I'll
crossed.
see you next week. Cheers.
See you next week.